For roughly 20 years, there was one rule in the gold market you could set your watch to. When real interest rates went up, gold went down. No exceptions worth mentioning. That rule has broken down, and it's happening again right now. At the same moment, 7 major Wall Street banks have year-end gold targets sitting meaningfully above today's price. And at the same moment, credit markets are flashing a warning about AI spending that's pushed one company's default insurance to its highest level since the 2008 financial crisis. If you own gold or silver, or you're trying to figure out whether the recent pullback is the end of the story or just a pause in it, give me the next few minutes. I'm going to walk you through why the old gold rulebook stopped working, what the banks are actually saying right now with real numbers, why a warning coming out of the AI sector matters more for your metals than you'd expect, and what's genuinely happening underneath silver that almost nobody covering gold even mentions. Stay with me, because these threads connect in a way most coverage treats as separate stories, and I'm going to give you the honest version, not the dramatized one. Before we dive in, I noticed that most people watching these videos haven't subscribed yet. If you're enjoying the content and want more honest market insights like this, take a second to hit subscribe and give this video a like. It really helps the channel and ensures you don't miss what's coming next. Now let's get back to the topic. Section 1. The rule that broke. Let's start with the mechanism because you need to understand it before anything else makes sense. For roughly 2 decades, from the early 2000s through 2021, gold and real interest rates, meaning interest rates adjusted for inflation, moved in a tight inverse relationship. When real rates fell, gold rose. When real rates climbed, gold fell. Analysts track this using the 10-year Treasury inflation-protected securities yield, and the correlation held with real consistency, averaging around negative 0.7 on a rolling basis. Starting in 2022, that relationship began breaking down. Real interest rates rose sharply as the Federal Reserve hiked aggressively to fight inflation, and under the old rulebook, gold should have fallen hard. Instead, it stayed resilient, and by 2024 and 2025, it was hitting fresh records even with real yields sitting firmly positive. The reason, according to analysts who studied this closely, is that central bank buying replaced exchange-traded fund flows as the dominant force setting gold's price. Central banks don't buy or sell based on this quarter's interest rate. They buy based on a decade-long reserve diversification strategy. And when that kind of buyer becomes the marginal price setter, the old rate-driven playbook stops fully explaining the moves. Here's the honest nuance, because it matters. In recent months, as real yields climbed again alongside a hawkish Federal Reserve, some of that old inverse relationship has started reasserting itself, and gold has come under renewed pressure. So this isn't the old rule is dead forever. It's that gold now responds to 2 forces at once, the real yield cycle and the structural central bank bid. And depending on which force dominates in a given stretch, gold can look either tightly rate sensitive or stubbornly decoupled. That's the real picture, more useful than either extreme. Quick ask before we go further. If gold, sometimes ignoring interest rates entirely and sometimes tracking them closely, has been confusing to watch, hit subscribe, because we're going to keep breaking down exactly which force is driving the market as it shifts. And I want to know, are you holding gold, silver, or both right now? And has this year's volatility tested your conviction? Tell me honestly in the comments. I read every one. Now let's get into what the banks are actually forecasting, because the real numbers are worth hearing in full. Section 2. What the banks are actually saying. Here's where I want to give you the real current figures, not a rounded up headline version. Goldman Sachs currently has a year-end 2026 target of $4,900 an ounce, a figure the bank actually cut from $5,400 back in June, citing fading ETF inflows and the market pricing out expected rate cuts. JP Morgan sits meaningfully higher, with a target in the $5,000 to $5,055 range for the back half of the year. UBS remains among the most constructive of the major banks, with a target in the $5,400 to $5,500 range, and an explicit upside scenario as high as $7,200 if geopolitical risk escalates materially. Bank of America has one of the boldest headline targets on Wall Street, a 12-month target of $6,000, with analyst Michael Widmer flagging an extreme demand scenario that could push gold as high as $8,000 by 2027 if fiscal deficit concerns and historically low investor gold allocations both intensify. Morgan Stanley sits more conservatively, near $4,800. Notice what's actually going on here. These banks disagree meaningfully on the size of the move, anywhere from $4,800 to $6,000 for year-end targets. But not one major bank currently has a base case forecasting gold lower than today's price. That's a genuinely unusual level of directional agreement among institutions that compete fiercely and routinely land on opposite sides of a call. The disagreement isn't up versus down, it's how far up. It's fair to note the track record here too. When gold first crossed into record territory in late 2024, the average year-end bank forecast at the time badly undershot where gold actually ended up. And that pattern repeated through 2025. Gold has consistently outrun the forecasts built around it. That's not a reason to treat every bank number as gospel, but it's worth noting that when these banks have erred, they've erred by underestimating gold, not overestimating it. Section 3. The warning coming out of the AI sector. Now here's the piece that connects to something most gold-focused coverage completely misses, because it's coming out of the credit markets around AI spending, not out of the gold market itself. Oracle's 5-year credit default swap spread, essentially the price of insuring against Oracle defaulting on its debt, climbed to roughly 203 basis points in recent weeks, the highest level on record going back to 2008, during the depths of the global financial crisis. That reflects bond investors demanding significantly more compensation to hold Oracle's debt, driven directly by concern over the scale of the company's AI infrastructure spending. In its most recent fiscal year, Oracle spent roughly $55.7 billion on capital expenditures building AI data centers, and even with operating cash flow rising 54% year over year to $32 billion, the company still posted negative free cash flow of nearly $24 billion. Rating agencies have taken notice, with S&P Global cutting Oracle's credit rating one notch, leaving it just one step above speculative grade. It isn't isolated to Oracle either. Credit default swap spreads tied to Alphabet, Amazon, and Meta have also been climbing, with Alphabet's own spread hitting a record after the company reported negative free cash flow. Analysts covering credit markets have described Oracle's CDS specifically as having become a go-to proxy for broader anxiety about AI capital spending across the sector, a way for investors to hedge against the possibility that the debt being taken on to build this infrastructure matures before the revenue to pay for it actually shows up. Here's why this connects to your metals. When credit markets start pricing real stress into some of the largest, most richly valued companies on earth, companies that have been the primary engine holding up broader stock market gains, it's exactly the kind of environment that historically pushes capital toward assets that don't carry counterparty risk. Gold and silver don't depend on Oracle's cash flow or whether AI revenue ever catches up to AI spending. If credit stress in the AI sector keeps building, and it's a genuine developing story, not a settled one, it adds another structural thread to the case institutional buyers have already been building through record central bank gold purchases. Section 4. The silver story. Most gold coverage skips. Everything so far has centered on gold, but silver has its own structural story running in parallel, and it's arguably more extreme. Silver is currently trading in the $60 range, well below its all-time high above $121 set on January 29th of this year. J.P. Morgan's commodities desk had forecast silver averaging $81 for the year and cut that in July to a $60 to $65 range, citing dollar strength and rate uncertainty, the same forces we just walked through with gold. But underneath that pullback sits a genuinely different structural story than gold's. The Silver Institute has documented 6 consecutive years of a global supply deficit, meaning the world has used more silver than it has mined every single year since 2020. That's not a one-time event, it's a persistent multi-year pattern. Unlike gold, silver carries a second engine of demand that has nothing to do with monetary policy or central bank reserves. Roughly half of global silver demand comes from industrial use: solar panels, electronics, electric vehicles, and data center infrastructure. And silver remains the best electrical conductor available for these applications, with no cheap substitute at scale. That industrial demand doesn't turn off because the Fed holds rates steady. At the same time, silver supply can't respond quickly to price signals because the majority of the world's silver comes out of the ground as a byproduct of mining copper, lead, and zinc. A mining company doesn't open a new mine because silver prices rose. It opens one based on the economics of the primary metal, and whatever silver comes along with it is incidental. That structural mismatch, demand that keeps growing against supply that can't expand quickly, is why a 6-year deficit hasn't self-corrected the way basic supply and demand would predict for almost any other commodity. Historically, silver has also shown a pattern of lagging gold in the early stages of a recovery, frustrating investors watching closely, before catching up and in some cycles outperforming it by a significant multiple once the broader monetary trade reasserts itself. That's not a guarantee it repeats this cycle, but it's a documented historical pattern worth knowing if you're holding silver through a stretch where it feels like it's moving slower than gold. I want to be careful here because it would be easy to stack these threads together and make them sound more conclusive than the evidence actually supports. On the real rate story, the relationship between gold and interest rates hasn't permanently broken. It's shifted to something more complicated, and it's actually been reasserting itself somewhat in recent months as real yields climbed. Anyone telling you gold is now completely immune to interest rates isn't being accurate. On the bank forecasts, these are forecasts, not guarantees, and the same banks currently bullish on gold have missed badly in both directions before. A base case of $4,900 to $6,000 by year-end is a real documented consensus, but it's a consensus, not a certainty. On the Oracle and AI credit story, elevated CDS spreads reflect genuine investor concern, but they don't guarantee a default or a broader crisis, and spreads have spiked and retreated before without an actual credit event. And on silver, a 6-year supply deficit is real and documented, but silver remains significantly more volatile than gold, and the same dollar strength and Fed uncertainty pressuring gold can weigh on silver just as hard, sometimes harder, in the short term. What all 4 threads share is this: they each represent a genuine, verifiable shift away from the calm, predictable environment gold and silver investors got used to in prior years. That's worth understanding clearly, without needing to dramatize it further than the facts already do. Here's what I want you to walk away with. The tight, decades-old relationship between gold and real interest rates has genuinely become more complicated, with central bank buying now competing with real yields as a primary driver of price. 7 of the largest banks on Wall Street currently have year-end gold targets ranging from $4,800 to $6,000, all above today's price, a level of directional agreement that's unusual even with the specific numbers varying widely. Credit markets are pricing real, rising concern about the debt fueling the AI infrastructure boom, with Oracle's default insurance costs sitting at their highest level since the 2008 financial crisis. And silver is sitting on its own 6-year supply deficit with an industrial demand engine that doesn't depend on any of the above. None of these threads alone tells you where gold and silver go next month. Together, they describe a market environment that's genuinely shifted, worth understanding clearly rather than reacting to whatever single headline crosses your feed today. I want to hear from you. Of these 4 threads, the rates decoupling, the bank forecasts, the AI credit stress, or the silver deficit, which one do you think matters most for where these metals actually go from here? Tell me why in the comments. I read every one, and it shapes what we dig into next. If this connected some dots that most gold and silver coverage keeps separate, subscribe before you go, because we'll keep tracking all 4 of these threads as they develop.